I have with me Girish Pai, Head of Research for Nirmal Bang Institutional Equities. Girish, thank you for joining us on Bloomberg Quint. Uh, just give me an idea of, did you expect NASSCOM to defer its guidance by a quarter?
No, not really. I mean, I don't think I've ever heard this being done in the past, so that's a bit of a surprise. But I was expecting not very robust numbers to come through from a guidance perspective, because we at Nirmal Bang have been bearish on the sector for almost 2 years now. So 2 years back, we had put out a call that we will see single-digit revenue growth for the industry, the tier 1 companies, when the street was expecting teens kind of growth. So the view is kind of panned out, but still I think the industry is expecting a turnaround in FY18. People say that there's going to be a cyclical turnaround driven by BFSI, also the fact that US economy is going to do better. I have my own issues connected with that view. I think this year tier 1 companies will grow anywhere between 3 to 6% in US dollar terms organically, and I stick to that view. Obviously, I think the fact that this has been pushed back by 3 months indicates that there's a lot of uncertainty in the market, despite the bullishness that one is seeing generally in the sell side. So the fact that there's macroeconomic uncertainty, the fact that Trump has come in and he's creating a lot of uncertainty. So all that is kind of contributing to the reason as to why I think NASSCOM has pushed this back.
NASSCOM also revises FY17 guidance from 8 to 10%. Now it says it's going to grow at 8.6%. And that too, we haven't seen the entire year go by. It's 10.5 months that they're projecting for the entire full year. You are betting. You are even more pessimistic. You're saying 3 to 6% for FY18, right?
So if you look at even FY17, there are companies which have delivered. I think some of the better companies would have delivered at 7 to 9% kind of growth. So your Infosys and TCS will probably deliver in that kind of range. I think the others, in my opinion, will be delivering 5-6% growth organically. And there are others like Wipro who are going to be delivering much lower growth. So that's the kind of picture we have. So I'm not really surprised. I think 8.6 is a par for the course number. I wasn't expecting anything significant beyond the number. So it's at the low. I wouldn't say at the lower end. Yes, I mean it's below the midpoint in once, and 9 would have been the big midpoint. So it's below the midpoint number. I think there is some visibility. I think if you look at the guidance that Infosys is given, they're talking about flat Q4, and TCS is saying it's going to be a little better than the Q4 of previous years and stuff like that. So I think broadly 8.6 is not going to make much of a difference. The fact that FY18 guidance has been pushed back means that there's uncertainty, more uncertainty compared to what the companies themselves are talking about. See, this what one should understand about NASSCOM guidance is it is a bottom-up driven guidance process. So the NASSCOM actually asks for numbers from the individual constituents as to what they're expecting for FY18, and they kind of amalgamate that, aggregate it, and give out a broad number. So to that extent, my sense is there is a great deal of uncertainty, at least in the tier 1 companies, in terms of what kind of growth is going to come through in FY18. Probably that is the reason why this has been pushed back.
You know, I was speaking to Cognizant earlier in the morning, and Malcolm was talking about, he expects the industry to grow between 7 to 8% in FY18. And he was very apprehensive that NASSCOM has always been aggressive in its targets, but it seems now NASSCOM is also coming to terms with the new reality, and they have revised the guidance midway within 3 months. Do you expect 7 to 8% for FY18 is achievable, or is still an uncertainty which is there, which is lingering?
So if you look at, I think the guidance given by Cognizant, if I recall correctly, was 8 to 10%.
8 to 10%.
So typically the Indian industry tier 1 players have been growing slower than Cognizant. If you look back in history, that's been the typical trajectory of growth for tier 1 companies vis-a-vis Cognizant. So I mean, I think a 7 to 8% number looks okay to me. I think that will probably have to revise downwards is my view, because as I said, my expectation is between a 3 to 6% kind of growth coming through, and probably the better ones will probably deliver a 6% growth, and not so good ones will probably come in at 3. So I'm talking only of organic growth. I mean, there could be inorganic elements in the growth which will probably come through when some of these companies make acquisitions. Some of them have made acquisitions in the recent past, so those numbers will add up in FY18.
And do you expect a lot of aggressive M&A happening in the IT industry as they chase growth now?
It's a very difficult call. See, the fact that you had Cognizant come out and talk about capital return to shareholders in a very aggressive way has probably been driven by elite management.
Yeah.
I think the shareholding of Cognizant is far more dispersed than is the case in, say, TCS or an HCL Tech or even Wipro. There it is fairly concentrated shareholding that one has in the hands of promoters. And I think there is aspiration for much faster growth than the 7-8%. So if you look at the Infosys number, they're aspiring for a $20 billion number by 2020, and which I think would mean that there should be some decent amount of M&A happening. But with Vishal Sikka saying that he's only going to buy companies which are futuristic, which have futuristic technology within them. I don't know how much that is out there in the market which you can buy with the existing amount of capital. So I think there should be a fair amount of. I think my own sense is that the 2020 target is a very, it's a very high target. I think it's not achievable. Probably they should kind of do away with that and aim for a modest revenue target. And if that gets done, then I think the process of returning capital to the investors or shareholders becomes much more easier. Because when you set a high target for revenue growth, then obviously the management and the board would want to retain a lot of the cash. They will say that you will require it for strategic reasons or for M&A and stuff like that. I think organically these companies cannot grow beyond mid-single digits is my view over the next few years.
And so either you return cash or go for an aggressive acquisition, which is not going to happen because there is a transformation which is happening within the industry as well, right? From the traditional IT companies, now the digitization is something which is there, and that's also disrupting the business models across industry.
Yeah, so I think this is something we highlighted about a couple of years back. I mean, it's not that something new, but this is something that was talked about, but not. I thought it was ignored by the sell side in one sense. So, what is happening is that our growth in India, in the Indian IT services sector, has been driven largely because of market share gain, driven by labor cost arbitrage. And now the business model is changing. The labor cost arbitrage model is going out of the window. And I won't say going out of the window completely, but it's slowly getting whittled. That competitive advantage is getting whittled because you have pieces of software which are coming and replacing human labor. So this whole talk of chatbots and RPA and automation, of cognitive automation and AI and all that is going to lead to a lower requirement of workforce, be it high-end workforce or low-cost workforce or whatever it be. So it's going to lead to lower amount of workforce requirements. That, in my opinion, is going to impact, it's going to cannibalize revenues of the Indian industry. So I would think that is definitely...
That revenue will contract?
Yeah, I think the traditional services business, the revenue is going to contract. Because the incremental... if you hear most of the companies themselves have been saying this. It's not something that I'm saying.
It's not apples to apples, right? While it will contract for traditional services, the same amount of revenue may not come from digital.
So that is the other piece of the puzzle. So what is being saved on the traditional services side by the customers is reinvested in the new side, the digital side. Now the issue on the digital side is the Indian companies do not have as much of a market share there because of various reasons. Because the fact that they don't have enough consultative skills, and I've been speaking to 2-3 companies here, 2-3 customers here. And the sense I get is a lot of the digital work, they want to do it themselves, especially the banks. Because they believe that they don't want to expose, sensitive data to third-party vendors. The work that is done is very collaborative and it needs to be done by teams which are working together. That, in their opinion, cannot happen as much with a third-party provider. So I think in digital, my view is that the market share that Indian companies have on the traditional services side isn't there as much on the digital side. And therefore, I think the shift of spend is actually not benefiting them as much. So I think that is the key thing. So on the traditional side, which is probably still about 85% of their business, that's contracting in my view. Part of that is contracting. Definitely in BPO, in IMS and application maintenance and all that, it is contracting by probably a high single digit to maybe low teen kind of number on an annual basis. So part of it is contracting. So obviously that piece is just going to degrow, and you need to find enough growth on the digital side, which is not large enough right now. Just about 15% of the revenues. Of course, in some companies it is a much larger number, but that piece is growing, but you don't have as much market share. But from a total revenue perspective, that still is not a large enough number for it to move the needle for the industry.
Girish, thank you very much for joining us on Bloomberg. Thank you. Thank you.